Hello and welcome to this week's edition of the Retirement Compass, brought to you by the team of Stonebridge Wealth Systems. I'm your host, Kristen Oakley, and I'm joined in the studio by the co-founder, Tim Kulhanek, and partner, Jeremy Gove. Today's show is very special. We are calling the attention of all State of Nebraska employees, whether you yourself currently work for the State of Nebraska or you know someone who is or who has in the past. You're definitely not going to want to miss today's show as we unpack some of the unique benefits available to you as an employee of the State of Nebraska. Tim, Jeremy, so great to be here with you guys. How's it going this week?
You know, you could have attended Hattie's third birthday party because the theme was pink. Everything was just pink.
Yes, well, it's my favorite color.
It's a great color.
I love that, and happy belated birthday to little Hattie.
Yeah, we had a great time.
Yeah, it's awesome. And I know you're another girl dad, Jeremy, and
yes.
But your girls are a little bit older, right?
They are. They're taking senior pictures this week, so it's kind of rough.
Oh my gosh, wow.
For my last daughter at home.
Oh my gosh, important milestones for sure.
It is important milestones.
Well, I'm excited for today's conversation because you all are very well versed in the benefits available to State of Nebraska employees. It's something that you work and you talk about a lot with your clients. And I know this is going to reach a vast majority of you who are watching today as well. To set the stage for today's conversation, this is according to the 2025 Nebraska Public Employee Retirement System, also known as NPERS, and their annual report to the legislator. This is what it discovered, that the system serves over 175,000 members and retirees, and 1 in every 11 Nebraskans are a member of NPERS. So it does affect a lot of people, right? Yeah. So the State of Nebraska cash balance and defined contribution plans serve nearly 48,000 Nebraskans with total assets in excess of $4.2 billion. That's billion with a B, a large sum of money. So with over 300 retirements happening across this state every year with these state plans, many Nebraskan families are sitting at home and wondering, and that might be you watching today, how do I maximize the benefits that I'm eligible for under these plans? And ultimately, a lot of people want to know, can I go ahead and retire? Am I ready to do so, right? That's the big question.
That's what we're going to help them figure it out, absolutely.
Yeah, for sure. So the first question for you, Tim, help us understand how these state and county plans work and how folks can start helping how you help current and future retirees make the most of their hard-earned savings in these plans.
Yeah, the first part of everything we do at Stonebridge is based off of education. You have to have the heart of the educator and make sure that the folks that you're dealing with, they feel comfortable because they feel like they have at least a loose understanding of what they're working with. And so I think it's important for us to talk about what we're talking about today and who it applies to and who it doesn't apply to. So we're talking about the state cash balance plan, the state defined contribution plan, and the county. You might work for a county. You might be out driving a road maintainer right now. Maybe you're listening to the radio show instead of the TV show. Probably shouldn't be watching TV in the maintainer. Besides, if you're like my pal Russell, you don't get any reception out there in Custer County, so you're not watching anything on maybe the radio, right? So county cash balance, county defined contribution plans. We're not talking about the plan like my mom participated in. She's a retired teacher. Now, she's a state employee, right? State of Nebraska. She's a member of NPERS, but that's why we said there's 175,000 members. This is 48,000. We're talking about, we'll do another show on the teachers, but we're not talking about school, judges, patrol, deferred comp, or OSERS, which is Omaha School Employee Retirement System, which is now folded into NPERS. So first, let's start with who does what. Like, what is this plan? How does the system work? There's a big company actually located in Lincoln, has a large presence in Lincoln, Emeritus. They're what's called the record keeper. They're kind of behind the scenes. They make sure that the statements are sent out and that all of the accounting behind the scenes is done properly. But NPERS actually processes the retirement applications themselves down there on K Street. I'm in Lincoln, so folks familiar with Lincoln will know what I'm talking about. They do all the refunds, the beneficiary designations, that sort of thing. Okay, so that's step one. Our first learning item is understanding that participation in the plan is mandatory. So it used to be that you could kind of choose. The plan started as a defined contribution plan, kind of like a 401k for a private sector employer. In 1964. Cash balance was added later on, so that didn't come around until 2002 through LB 687. And since then, automatic participation is for cash balance. So if you're hired for the state of Nebraska, you're automatically going to be enrolled in and participate in the state it's defined contribution, defined benefit cash balance plan. you cannot opt out, okay? So you get hired, you're going to participate in this plan. So second learning item is this: the amount you contribute is predetermined. So I'm going to pull up on the screen, we're going to have an example of what that might look like if you work for the state of Nebraska. So let's say that you're hired for the state of Nebraska, and you make $70,000 a year. You're going to have a mandatory contribution of 4.8% of pre-tax money that's going to go into that plan. Now here's the generous thing. This is great for a state employee. They're very generous with their match. The match is actually 156% of your contribution if you're a state employee. It's a little bit different. It's 150% for county. But what you can see there is that means that you're putting in $3,360 of your money, but then you get that 156% match on top of that. And that means that they're putting in, the state's going to kick in another $5,241.60. So for someone who's making $70,000, they're going to have more than 10% total going of their total salary going into the plan between their contribution and the state, because your total contribution in this scenario is $8,601.60 of your salary. That's 12.29% for the year. And you only had to kick in 4.8%. So the match is really where you're getting the big benefit with cash balance when it comes to the contribution itself.
That is extremely generous.
Very generous.
To have between 150 and 156% match, I feel like
incredible.
That I have not heard that anywhere else, right?
It's pretty unique. Yep.
Yeah, for sure. And so that's really generous. The second thing to note is that the amount is not only predetermined and fixed, but you cannot save more in this particular plan, but it's also pre-tax. So is there no Roth option for folks?
Correct. And this is why having a robust financial plan outside of just what's available through your employer is so critical, because there isn't a Roth option. It's all pre-tax money, so it's under that tax-deferred paradigm. You're deferring your salary to a future date. And if you've watched the show for any period of time at all, you know that we believe that you're deferring your salary to a future date where, based off of the government's catastrophic disarray of a balance sheet, tax rates could be stratospherically higher. And so you have to really be mindful of where your additional savings dollars are going, because this is all pre-tax money and you're going to eventually owe taxes when that money comes out.
For sure. And I know tax planning is a huge part of what you and the team of Stonebridge Wealth Systems do for folks. So another thing to point out, so Jeremy, we often hear that a reason for working in the public sector versus the private sector is the benefit package, right? That's what's really attractive about it. And it's sounding pretty good so far, but for retirement savers in the state of Nebraska, what else can you tell us about how these plans operate?
So I think it's important to distinguish between the defined contribution plan and the cash balance plan. So let's start with that. So let's start with the defined contribution. So that's similar to a traditional 401k, like most employers have. So we actually have a slide, if you want to pull up the risk bucket. So if you want to think about, okay, so where does that money, if I'm putting that money in, where does that end up? That's going to be at the on the high risk or the high risk investment piece of it, because all of that money is at risk.
Right.
Okay, so it's a traditional 401k.
Yes.
Right. I apologize, I couldn't read part of that.
So it's all good.
So it's the high risk part. So that's how that works. It's going to be a traditional 401k. You're investing money, you're picking the different investments inside of there, and that's one of the downfalls to this plan, because we've talked about this a lot. When you're going and you're running a maintainer or you're doing different jobs, are we an expert in picking those investments, on what we're going to invest in? And the challenge is there's a limited number of investments anyway.
Right.
So that presents a little bit of a challenge. So that's where advisors can help a lot with that. So the second part, so that's the defined contribution plan. So now let's talk about the cash balance plan. Okay. So the cash balance plan is going to have it's going to work more like a money that you're just putting in. It has if you want to pull up the slide showing the crediting rates, there we go. So it has a fixed rate of return of a minimum of 5%. And depending on what's going on, it could be higher. So the way that they calculate that, they're using the federal midterm rate, and then they're adding 1.5% to that. So if you look at the rates, if you go clear back to 2010, you're going to see the year average, that far right column, is 5%. And it's going to be that all the way through 2022, because interest rates were really, really low, right? So there wasn't going to be, you're going to get the minimum. And then you can see in 2023, that jumps up to the average is 5.68%, and so on and so forth. And so, for example, in 2025, The July Q3, it's 4.19%. So if you add the 1.5% to that, you're at 5.69. So that's how that works going forward. And so if we go to the, let me back up. The cash balance plan works two different ways. You can either get the fixed rate, or you can actually have a dividend rate. So the dividend rate works a little bit differently because you have, it's not either or, it's added to. I'm sorry, yes, it's added to. So I was trying to find the name, the
Public Employee Retirement Board.
Thank you.
Yeah.
No, that's a mouthful to say, yes.
Yeah, I was going to say PER, but nobody knows what that means. So, so the Public Employee Retirement Board, they meet and then they determine, is there an additional dividend that could be paid out? And so each year they come to that conclusion. There are some rules that they have to follow. For example, it must remain 100% actuarially funded before and after the distribution or the dividend payment. And so in 2025, the dividend for the state is 0.95% and the county is 0.84% on top of, thank you, on top of the 5.69 or whatever the dividend is, or the interest rate is, fixed rate.
Right.
And so, so if you look through those dividends, they could fluctuate based off of what's going on in the markets and what's going on with the
It's not guaranteed.
portfolio.
Right. The bottom line. Right.
Yes,
well, and they have a max, kind of a cap on how much. It's like 8%. It shall not exceed 8% unless a majority of the Public Employee Retirement Board says, yeah, we're going to do more. But here's what I want to leave this segment with our viewers with this segment. There's a key component to earning this dividend, because this could be a lot of money. There's a lot of folks that come into my office. They've got hundreds, if not $1 million plus in the cash balance plan. If you don't have a balance on December 31st, you are not eligible to receive the dividend. So if you've been meeting maybe with an advisor and you're trying to figure out, should I do a 401k or a employee rollover, so to speak, a distribution from the cash balance plan into an IRA to have somebody manage it, professionally manage it. If you don't need the money today, right away, and you can continue to defer that money, at the very least, ensure that you have it balance by December 31st. Don't take the money out sooner than that, because you would then be forfeiting a dividend. Recently, just last year, I had someone who came in, they wanted to take their money out. Like, that's how I get paid, right, is to manage people's money. I told them to leave the money in the plan. Why? When they did roll the money over in January the following year, there was an extra like $25,000 that was going to be coming to them later in the year through that dividend by just using a smarter plan. So if you work for the state of Nebraska and you're not 100% confident that you got our arms around how this plan works, whether it's defined contribution or cash balance, please, I'm telling you, we can give you some help when you call that number on the screen.
Wonderful. Tim, Jeremy, thank you so much. There's clearly a lot to know, and I'm sure it creates a lot of confusion for folks. And to your point, it's been placed on the burden of the employee to try to figure this stuff out. But here's the good news. You don't have to go it alone. This isn't new to Tim and Jeremy and the team of Stonebridge Wealth Systems. They've helped lots of Nebraska state employees navigate through these things successfully, and they would love to do it for you as well in the form of a complimentary written financial plan. To claim yours, simply call 866-256-7778, or you can connect online by scanning the QR code that you see below. We'll be back with more of what you need to know about retiring as a state employee right after this.
I own a motel I was able to buy out of college. When I actually ended up buying the motel, I was leaving. I had just passed the life and health license, and I was gonna sell Medicare supplements and long-term care. I told the owner of the motel that, hey, I'm gonna be leaving. I was giving him a 6 months heads up that, hey, I'll train whoever you wanna bring in. He said, I'd actually rather sell you the motel than bring in a new manager, because he never showed up. So he didn't have to do anything. It was kind of like an ATM for him. And so, you know, when you own your own business, there's a lot of people that got to be paid. There's marketing that has to be done. There's a lot of different dynamics that go into running a motel. It actually taught me to think outside the box a little bit. And so I started looking around, what are other things I can do? Because I really liked helping people. I liked solving problems for them. And there's a big difference between selling something and actually finding solutions to problems. When you're thinking about personal finance and managing somebody's retirement for them, they've worked for 40 years saving all this money, and now they're retiring. They're turning this over to you to take and run with it. So it's a big deal. I think we can always do stuff better. There's always room for improvement. And so I want to read as much as I can. I want to study as much as I can so that I can do a better job for my clients, which they're counting on me to get the job done for them.
Welcome back. You're watching The Retirement Compass. I'm Kristen Oakley here with both Tim and Jeremy from Stonebridge Wealth Systems, and a great conversation we are having today about what you need to know as a retiree from the great state of Nebraska, specifically for public employees. And gosh, there's so much to know, as we saw in the first segment, right? The difference between the cash plan, the defined contribution plan. A lot of it has to do with how that money is growing and whether it has risk or it doesn't have risk. Let's talk about the growth with risk. So that's the defined contribution plan, right?
Yeah, so again, it's like your typical 401k, right? So the options that you have inside of this plan, they're pretty limited. You have the core, you have traditional investments, meaning you don't have alternatives. So there's not a lot of alternative investments outside of the traditional stocks and bonds, right? And so I guess the simple way that we talk about that's kind of the one size fits most investment option, right? So you're not really getting to truly diversify or truly allocate your funds, but you're using that one size fits most type of a strategy.
Yeah, for sure. Well, I know one of the things that you have shared with me is that a lot of folks are reaching out specifically to you guys and to your team because a lot of advisors out there aren't very well versed in these plans and what that means for folks, right?
Yeah, that's exactly right.
They usually just want to do a rollover. Like I was saying at the end of the first segment, they're like, well, why don't you just give me your money and then we'll worry about it from there. But they could be forfeiting major benefits by just making a knee-jerk type of reaction to how they should handle retiring from the state. It's very, very critical that they take a very serious look at this.
Yeah, for sure. And just if you're just tuning in, the example that you shared, that person was about to miss out on $25,000 additional dollars in the form of a dividend,
it's
right?
Free money.
Yeah,
right. Because this is a guaranteed plan. Cash balance, you cannot lose money. If we think about those risk buckets, I call them safety, growth without risk, and growth with risk. Defined contribution for sure is growth with risk.
Right.
But that's not where cash balance lives. It's growth without risk because you get a guaranteed 5%. In some years, you might get 7, 8, 9%. Like it's incredible opportunity, and you don't want to leave the money on the table. You'll be dripping nickels.
Right, for sure. Well, let's move on now. So a lot of folks watching are at the phase where it's time to now take income from this money, right? You've worked hard, you've saved into these plans. How does one go about starting to distribute the income for themselves out of these plans?
Yeah, I would just define it by what does retirement mean if you're a state employee. So according to the handbook for the state of Nebraska, retirement is you separate from service after age 55. That's not in the year you reach 55, it's after you've attained age 55. Termination is everything else. Now, why is that critical? Because there's IRS rules that say, hey, in order to take a qualified distribution from a retirement plan, you have to have achieved age 59 and a half. Not the year you reach 59 and a half, but you have to have achieved age 59 and a half. Okay, so we want some clarity there. Unless you retire from the employer that you're working for after age 55, in which case you can take a qualified distribution, which means no 10% penalty.
Right, so, for the early withdrawal.
For the early withdrawal.
Right, yeah.
That's the key of the qualified distribution. So if you retire after age 55, you're eligible for a penalty-free withdrawal. It doesn't mean tax-free. It means penalty-free withdrawal from either of these plans. It does not apply to money outside of this plan, though. So if you have an IRA, so just a traditional IRA or a Roth IRA, and you say, oh, I retired after age 55, I can take money out penalty-free now, only applies to the money that's inside this plan, not to additional resources that are qualified accounts like IRAs or Roth IRAs.
Yes, so that answers the question of when. Let's now answer the question of how. How do folks go about taking, distributions from these state plans?
Yeah, so let's just talk about the defined contribution plan. Again, that's the 401k-like plan, right? So there's not a requirement that you have to take the funds out of the plan, right? But if you do want to take money out of the plan, there's several ways you can do that. You can take a lump sum, which that's going to be taxable, because remember, we haven't paid tax on this money yet, so you're going to pay tax on it. That's usually not a good idea to take it all as one lump sum. But what's unique about the defined contribution plan is you can roll money over. There's no limit on how many rollovers you can do. So you could roll over or take a distribution. So let's say we wanted to set up a systematic withdrawal. So we're going to get monthly income out of that. We could roll part of that money over to another, let's say to an IRA or something like that, and then continue to pull money out of that. That you could also do a monthly annuity. So they're just going to set up an income stream just like a traditional insurance company would with an annuity. That's another option, or you can do a combination of all of those things. So we could take a lump sum distribution of a few dollars and then take distributions monthly and or roll money over to another plan.
Right. Well, I know we need to wrap up this segment, but what do you want to leave our viewers with in what we've talked about so far here?
I mean, I think that the most critical thing about all this, like, we make these show notes in advance to make sure we're prepared. We could probably do 4 or 5 shows on this topic alone.
For sure, yep.
And this is what we do for a living. And so if this is our area of expertise and there's so much information to try to pack in, imagine trying to do it on your own. It really isn't fair, and that's why you deserve to have a trusted ally in your corner, someone who's traveled the path, knows when to zig and when to zag, and that's what you're gonna get when you call the number at the bottom of your screen and you work with one of the advisors, one of our experienced advisors at Stonebridge. We've flown the plane and we've landed it for dozens, if not hundreds, of different employees who work for either the county, somewhere on the 93 counties we talked about, or the state of Nebraska. We are excited to do the same for you. We're excited to hear from you when you call the number at the bottom of your screen.
Wonderful. Tim, Jeremy, thank you so much. To our viewers at home, that number to call is 866-256-7778, or again, you're welcome to scan that QR code and that will get you connected as well. We'll be back right after this.
You know, if you think about the average American consumer, we don't talk about financial topics very often. And so we spend a lot of time at Stonebridge doing educational seminars and different things that are free of charge. If you're not educated in a topic, how do you make educated decisions? When you're working with a client, you're sitting down with them, they're a little stressed out, but after you go through the process and you really take time to educate them on not only what we're doing for them, but why we're doing it, that really gives them peace of mind, and you can see the weight just kind of drops. And when they leave, I hear all the time, I really should have done this years ago.
But sometimes there's a fear that somebody might try to sell us something. If the things that I can provide, if you don't want, don't need, or can't use those, I've got some good news for you. We're not going to sell them to you. We are fulfilling our fiduciary duty of putting their interests ahead of our own.
Welcome back to the Retirement Compass. I'm Kristen Oakley here with both Tim and Jeremy from Stonebridge Wealth Systems, and this has been a really informative show today, especially for all of you watching who work for the state of Nebraska. There is so much to know about the retirement plans that are available to you, and you guys are experts in this. This is what you do day in and day out for folks, and I know it's something that really sets you and the team apart. It's why a lot of folks call in and connect with you because they need help, and rightly so. We've already established that there's so much to know here. I want to go back to something you were talking about, how folks can generate income for themselves from these defined contribution plans. You mentioned the term monthly annuity. I think we need to explain that because obviously the word annuity can really raise some, ruffle some feathers, if you will, with folks. A lot of people are like, "Ooh, I've heard those aren't good." So explain that.
Yeah, so an annuity by definition is just an income stream. It's a stream of payments, right? And so with the cash balance plan, you have the option to annuitize a portion or all of that money that's in the cash balance plan. And basically what you're doing is you're turning it into an income stream. There's tables to figure out how much money you're going to get for the money that you have in the cash balance plan. They're going to pay you X amount of dollars per month, and then you can make the determination, is that the best plan for me, or should I roll a portion of that out? Now, the challenge with the cash balance plan is once you make that decision, it is irrevocable. So you want to make sure that you're making the right decision for your situation. And sometimes that can be challenging if you're retiring at 62. There's a lot of life left. We don't know what's going to happen in the future. So we just want to keep that in mind, that it's an irrevocable decision.
Yeah, for sure. And correct me, as you were talking, I was reminded of a situation we had, I think last year, where all of a sudden folks had to make a decision really quickly. Do you remember what I'm talking about? And you guys were called upon to kind of give advice on that?
That had to do with annuities. That was actually a company, a local company. Well, I say local company, it was Kawasaki. They terminated their pension. And it was one of those things where we talk about annuities. Annuities get a bad name. I was looking at this stat. The 2024 edition of Americans' Views of Retirement from the National Institute of Retirement Security. So this is their National Retirement Insecurity Study they do every day from the Institute on Retirement Security.
Right.
Tongue twisters here, we've got riddles. Over 3/4, a full 77% of respondents indicated that they believe that those with pensions, like the kind that either mom and dad, grandma and grandpa, or Kawasaki was offering, are more likely to enjoy a secure retirement. Okay, 77% of Americans agree with that, yet because of some of these gurus and the Ken Fishers of the world, annuities have kind of a bad name. Well, the state of Nebraska offers this annuity payout, and you can get an annuity from the defined contribution, but it's not near as beneficial as that of the cash balance plan.
Okay.
Cash balance is 2 tiers. Tier 1 is you were hired before January 1st of 2018. Tier 2, the payouts are just a little bit lower, but they're still pretty generous. Most of the people that we're working with, they were hired long before. A lot of long-term employees, state employees, people are pretty loyal to the state of Nebraska.
Sure.
They worked there 30, 40 plus years.
Yep.
But I'm seeing payout rates 8, 9, 10, 11% depending on their age and the strategy they use. So here's what I want to leave you folks with. If you're reaching this, you've reached the top of the mountain, right? You're past the accumulation phase, and you're trying to figure out how do you get down off this mountain? How do I distribute this money in a responsible way so my money lasts as long as I need it to, and if it's important to me that I can leave something for the next generation? You need to make sure you get this part right. There's kind of an all or nothing aspect to this when it comes to the cash balance plan. When you go to take money out, you don't have to annuitize all of it. You could roll all of it out. You can also do a combination of the two, but you can't, once you take $1 out, you gotta take all of it out. So if you're struggling with how much money am I gonna need in retirement? What is my budget actually going to be? Am I gonna spend less in retirement or more? We have a system in place called the Retirement Compass that's gonna help you figure out all that information, how much you need, what account to draw from, and when. We can be your guide to and through retirement. And if you're a state employee, we're obviously well-versed in what this looks like and what your options are to maximize those benefits to serve your purposes, and we're excited to help you when you call the number at the bottom of your screen.
Yes, absolutely. And you're local, you guys are born and bred Nebraskans, right? You understand this stuff.
Mom was a state employee.
Yes, yes. Lots of personal firsthand experience with this,
absolutely.
which is awesome.
Yeah.
Well, thank you for sharing your expertise today. Obviously, there's a lot to know, a lot to get through. The best thing you can do for yourself is there's really no substitute for sitting down in the financial planning environment and seeing what this means for you and your family. Again, the team of Stonebridge Wealth Systems would love to be able to meet with you. It's for no cost, no charge, no obligation. So we encourage you, pick up the phone and call today to schedule your time to come in and receive your very own complimentary written financial plan. 866-256-7778 is the number to call, or just click that QR code. Be safe, be happy, be blessed, and we look forward to being back with you next time here on the Retirement Compass.